Ally Financial Incorporated stock is crashing. The company has seen an instant 18% drop after the company's CFO reportedly noted intensifying credit challenges among borrowers during a financial conference. Before this crash, the stock was trading at around $39, and now it's down to $32, a level not seen in quite some time, wiping out several months of gains in just one day. Meaning investors clearly aren't happy with the news, and this immediate sell-off speaks volumes about the concerns surrounding Ally's future performance and the broader economic landscape. So why is this happening, and what should you do as an investor? Well, I've gone through the details of the conference, the company's latest financial disclosures, and the market's reaction. And in this video, we're going to break down everything you need to know. We'll look at the key factors behind the crash, analyze the markets and analyst reactions, and most importantly, we'll discuss what you should consider doing in the midst of this significant drop. Be sure to watch it till the end, and don't forget to subscribe for more stock market updates and insights. Now, let's dive into the details of what went wrong and why Ally Financial is facing such a significant sell-off. Okay, so the key reason behind this sharp decline is the comments made by Ally's CFO, Russell Hutchinson, where he pointed out that the company is experiencing growing credit challenges in its borrower base. He specifically highlighted the issues in Ally's core retail auto loan segment, which has long been a primary driver of the company's business. According to Hutchinson, delinquencies in this segment have risen by about 20 basis points during July and August compared to the company's initial projections. This means that a larger percentage of borrowers are falling behind on their auto loan payments than the company had anticipated. This increase in delinquencies is not just a short-term blip. It reflects deeper financial challenges faced by Ally's customers, who are struggling with the effects of high inflation and rising living costs. Over the past year, inflation has put enormous pressure on consumers' wallets, making it harder for them to keep up with payments on everything from mortgages to credit cards to auto loans. What's particularly concerning is that this trend seems to be accelerating. Hutchinson noted that Ally's borrowers are not only being squeezed by inflation, but also by a softening job market. Our borrower is struggling with high inflation and cost of living, and now more recently, a weakening employment picture, he told investors. This paints a worrying picture of the future, especially if unemployment continues to rise or inflation remains stubbornly high. In addition to the increase in delinquencies, Hutchinson revealed that net charge-offs in the retail auto loan sector rose by around 10 basis points during the same period. A net charge-off is essentially a loan that the company deems unrecoverable, meaning it doesn't expect to collect on it. When these charge-offs increase, it directly impacts the company's profitability, as they represent loans that will never be repaid. The fact that both delinquencies and charge-offs are rising faster than expected is a clear signal that Ally's loan portfolio is under stress, and investors are right to be concerned. One of the broader economic factors contributing to these challenges is the Federal Reserve's ongoing fight against inflation. Over the past year, the Fed has raised interest rates significantly in an effort to cool off the economy and bring inflation under control. While these rate hikes have helped to reduce inflation somewhat, they've also made borrowing more expensive for consumers. Higher interest rates mean higher monthly payments on things like auto loans, mortgages, and credit card debt. For Ally, whose business model is heavily reliant on consumer lending, this creates a difficult environment. As rates go up, it becomes harder for borrowers to keep up with their payments, leading to higher delinquencies and charge-offs. Another factor that has contributed to the recent sell-off in Ally's stock is the regulatory environment. Recently, Federal Reserve Vice Chair for Supervision, Michael Barr, proposed new rules under the Basel III framework, which would impose stricter capital requirements on banks and financial institutions. These rules are aimed at making the financial system more resilient by ensuring that banks hold more capital in reserve to protect against potential losses. While this is a positive development for the stability of the financial system as a whole, it presents challenges for companies like Ally. Tighter capital requirements could limit Ally's ability to lend or invest, especially in a challenging economic environment like the one we're currently facing. The market has reacted negatively to these proposals, and that has contributed to the sell-off in bank stocks, including Ally. The broader macroeconomic environment is also playing a role in Ally's struggles. The most recent U.S. jobs report missed expectations, leading to concerns about the health of the labor market. If the job market weakens further, it could exacerbate the issues Ally is already facing with delinquencies and charge-offs. When people lose their jobs or face reduced hours, they are more likely to fall behind on their loan payments, which would further strain Ally's financials. So, what does all of this mean for Ally Financial's future? On the one hand, the company is clearly facing some serious challenges in the near term. Rising delinquencies, increasing charge-offs, and a difficult regulatory environment are all putting pressure on Ally's business model. If these trends continue, we could see further deterioration in the company's financial performance, which would likely lead to more downside in the stock. However, it's not all doom and gloom. During the conference, Hutchinson made it clear that Ally is aware of the challenges it's facing and is taking steps to address them. He emphasized that the company is prioritizing capital and expense management going forward. This means that Ally is likely to focus on tightening its lending standards, reducing its exposure to riskier loans, and cutting costs where necessary to preserve profitability. While Hutchinson noted that the company is not revising its financial guidance at this time, the fact that they're taking a proactive approach to managing expenses suggests that they are preparing for a more challenging economic environment. So, what should you do as an investor? Is this sell-off an opportunity to buy Ally stock at a discount, or should you avoid the stock altogether? If you're a long-term investor with a high tolerance for risk, there is a case to be made for buying the dip. Ally is a well-established company with a diverse range of financial services beyond just auto loans. While the retail auto loan segment is currently under pressure, Ally also offers credit cards, home loans, checking and savings accounts, and other financial products. This diversification could help the company weather the storm in the auto loan market and emerge stronger once the economy stabilizes. Additionally, Ally stock is now trading at a significant discount compared to its recent highs. If the company is able to navigate these challenges and return to growth, there could be considerable upside potential for investors who are willing to wait out the current turbulence. Of course, this is a speculative bet, and it's important to consider your own risk tolerance and investment horizon before making any decisions. On the other hand, if you're more risk-averse or concerned about the broader economic environment, it might be wise to hold off on buying Ally stock for now. The increase in delinquencies and charge-offs is a clear signal that the company's loan portfolio is under pressure, and if the economy continues to weaken, these problems could get worse before they get better. Moreover, with the Federal Reserve keeping interest rates elevated and the potential for more regulatory challenges on the horizon, there's a lot of uncertainty around Ally's future performance. In conclusion, the sell-off in Ally Financial stock is a reflection of the challenges the company is facing in its core business, particularly in its retail auto loan segment. Rising delinquencies, higher charge-offs, and a difficult regulatory environment are all weighing on the company's outlook. Whether you should buy, hold, or sell Ally stock depends on your individual risk tolerance and investment goals. If you believe that the company can weather these challenges and return to growth, this could be an opportunity to buy the stock at a discount. However, if you're concerned about the broader economic environment or the company's ability to manage its credit risks, it might be best to wait for more clarity before making any investment decisions. Well, that's it for today's update on Ally Financial and the recent stock crash. As always, it's important to do your own research and consult with a financial advisor before making any investment decisions. If you found this video helpful, don't forget to give it a thumbs up and subscribe to the channel for more updates on the stock market, financial news, and investment strategies. Thanks for watching, and I'll see you in the next video.